Welcome back, financial adventurers. Today, we're diving into the world of banking and unraveling the mysteries of the fractional reserve banking system. Get ready for an eye-opening journey. Let's start with a simple question. What is fractional reserve banking? Well, imagine you have $100 in your pocket. You decide to deposit it into a bank for safekeeping. In a fractional reserve banking system, banks are only required to keep a fraction or a portion of your deposit as reserves. This means they don't hold on to all of your money. Instead, they lend out a significant portion of it. Let's say the reserve requirement is 10%. That means the bank only needs to keep $10 of your $100 deposit as reserves and can lend out the remaining $90 to borrowers. Imagine someone comes along and wants to borrow money from the bank to start a business. They request a loan of $90, and the bank, using the money from your deposit, lends it to them. Now, that borrower has the money to invest in their business. They purchase equipment, hire employees, and start producing goods or offering services. As the business operates and earns money, customers come in and purchase their products. The business owner makes a profit from those sales. But here's where things get fascinating. The money earned by the business doesn't just stay with them. It eventually finds its way back into the banking system. When the business owner deposits their earnings back into the bank realizes it can lend out a portion of that money again, thanks to the fractional reserve banking system. Let's say the bank maintains a 10% reserve requirement once again. They keep $9 of the business owner's deposit as reserves and lend out the remaining $81 to another borrower. This process of lending and depositing continues, creating a multiplier effect on the money supply. Each time money is deposited, the bank retains a portion and lends out the rest, allowing it to be used for various purposes like buying homes, starting new ventures, or funding education. Now, let's take a step back in time. Before the fractional reserve banking system as we know it today, there was a different system called the gold standard. In the early 20th century, and even up until the 1970s, many countries operated under the gold standard. This meant that the value of their currency was directly linked to a fixed amount of gold held by the central bank. Under the gold standard, paper money and coins were essentially certificates representing a specific amount of gold, which people could then exchange their paper money for actual gold at any time. But as economies grew and evolved, governments and central banks found it challenging to maintain the gold standard due to various reasons, including economic fluctuations and the need for flexibility in monetary policy. So, over time, the fractional reserve banking system emerged as a way to provide liquidity to the economy, facilitate lending, and support economic growth. Now, while the fractional reserve banking system plays a crucial role in the economy, it also poses some significant risks. Now, what happens if too many people simultaneously wanted to withdraw their money from the bank? If too many depositors demand their money back all at once, the bank might face difficulties because they don't hold on to all the deposited funds, and often will only have the bare minimum of 10%, which is far less than the amount owed. This is what we call a bank run. During a bank run, a bank may be unable to meet the demands of all its depositors, potentially leading to its closure. This is why we often hear about the importance of a bank's stability and trust in the financial system. To summarize, fractional reserve banking allows banks to lend out a significant portion of the deposits they receive, stimulating economic growth. However, it also carries the risk of bank runs if depositors panic and withdraw their funds all at once. By understanding the fractional reserve banking system, you can better grasp how banks operate and the importance of maintaining stability and confidence in the financial system. Keep exploring the fascinating world of finance. And remember, knowledge is power when it comes to your money. Stay curious and keep building your financial literacy. Thanks for joining us at Finance Simplified 101. If you found this video helpful, don't forget to hit that like button and subscribe to our channel for more simplified finance content.